What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of June 2024, where in each episode I pick 3 new stocks that I feel are looking attractive at today's prices for the long term. And to make it more fun and interesting, I specifically choose one lower risk, one medium risk, and one higher risk option for added variety. As always though, just please remember to do your own research and make your own decisions. I'm only showing you some stocks that I happen to like, but we're all different with our own opinions and needs, so you should only do whatever is best for you. Regardless, if you're enjoying the series, then please consider subscribing and hitting that like button. It really helps keep my channel alive and it means a lot to me, so thank you for that support. But with all of that said, we've got 3 awesome stocks that I can't wait to share with you. So let's go ahead and dive straight into it. All right, and first up here on the list, we will be starting with our lowest risk option first. And this month, I'm going with the media giant Disney, ticker symbol DIS, who really doesn't get talked about nearly as often as it used to, where back during the pandemic, it was one of the highest flying stocks because of how many people were stuck at home using video streaming platforms. And as such, Disney stock had soared to about $200 a share at one point. However, since then, it's proceeded to lose about half that amount. And here's the most interesting part. Today, Disney stock trades even lower, significantly lower really, than almost all prices before the pandemic ever even happened. And look, anytime that Disney has traded for around $100 a share, for me, that's always been a level that I want to be buying at. Now, most recently, the stock also fell over 10% this past month coming off of earnings, where sales only grew by 1% in the quarter while also missing expectations for the 4th quarter in a row as they continue to hurt from their linear network business that has been in decline for a while as they attempt to transition over to streaming, where all the growth actually lies. And thankfully, that part of their business is actually doing quite well. Last quarter, for example, Disney Plus and Hulu reported a combined profit for the first time ever, and the entire streaming segment should also be profitable this year going forward. Guys, that's huge news because it's really what investors should be paying the most attention to, as it's been the biggest drag on their financials with just how much money they've had to pour into streaming as they attempt to transition over the business. But you look at guidance now for the full year, and management claims to be on track to exceed their $7.5 billion cost-cutting initiative, which will help drive even higher EPS growth than previously expected from 20% up to now 25%. That's huge. And just as important, they're guiding for more than $8 billion of free cash flow. Guys, that's a giant positive, probably the most important because it's easily the largest amount of cash that they've generated in many years, and it marks a clear return to solid profitability, which, by the way, they're now using to not only buy back billions in stock while the price is still low, and of course that helps their EPS numbers, but they also increased their new dividend by 50%. Now granted, I don't really care about that dividend because it's only yielding about 0.3% to start with. But again, the biggest motivator for me is just how beaten down the stock is with a valuation that is also a bit cheaper than the sector by PEG and over 60% cheaper than their own 5-year average as well, which at those levels, I actually think there's a few catalysts that could help rebound the stock much sooner than people might think. For one, they recently announced a new streaming bundle that will include Warner Bros. Discovery, which could theoretically house Marvel, Star Wars, DC, Game of Thrones, HBO, FX, Discovery, Disney, Pixar, Fox, Food Network, and so much more under just one paid bundle, either ad-free or ad-supported for multiple price points. And another big thing to remember is that Disney's box office revenue has been falling these past couple years due to a lack of new content and also a writer's strike going on, which sunk their market share from well over a third to now just around 16%. However, there are actually a few hitters coming this year that I think could be big. Notably, we recently had Planet of the Apes do surprisingly well, and we have much more on the way from some of their biggest brands, including Inside Out 2 from Pixar, a new Alien movie, new Lion King, and even a few more big titles following the next year, like Captain America, a new Snow White, and even a new Fantastic Four. But of course, the biggest of all of these is that new Deadpool and Wolverine movie coming this summer, which I think will do giant numbers as those are probably the two most popular characters from Marvel at the moment, which, by the way, can also help fuel their streaming service even after the theatrical release as well. Plus, keep in mind, we're also going into summer now, and I think that their theme parks and resorts business should also see a nice uptick there as well. I was actually at Disneyland back in like February, and I went on a weekday, trying to avoid the crowds. I thought everybody would be at work or in school, and it was still insanely packed. I couldn't believe it. So I really can't imagine what the numbers are going to look like during summer, and I think it'll do pretty well. Anyway, all of this to say that I just think that, for what is arguably the largest media and entertainment leader in the world, to be trading cheaper than the sector, I'm not sure how long that can last. And while they certainly have many issues, I just don't think that I would get the price this cheap if it didn't have some problems with the company. So I'll take the bad with some of that good there, the good being the stock price being cheaper, a good value, and I'll try to be optimistic about it long term. Anyway, while I do own Disney stock already myself, one stock that I do not own yet, but that I am very likely going to be starting to buy here in the coming weeks for both my personal portfolio and the community one, because I like it that much, that stock is number 2. It's going to be Cisco, ticker symbol CSCO, which is our medium risk option for the month. Now, look, when it comes to that risk for Cisco, I feel that it's mostly to do with them being a bit more of a legacy player that hasn't had, I would say tremendous growth as maybe some of the other bigger names in tech, as they were founded all the way back in the early 80s, but they really helped establish the internet that we use today, with also many of their routers and switches connecting most computers around the world, which I'm not saying that that's a bad thing. It's actually led to some pretty strong performance. In fact, if you exclude the internet tech bubble crash of 2000, Cisco stock has actually performed quite well in the many years after. However, I also think that it's a great value for their work in advancing AI, cloud computing, cybersecurity, and all of the growth potential that comes along with all of that. Most AI-related stocks skyrocketed this year, but Cisco actually fell by close to 10%, leaving the valuation around 40 to 50% cheaper than the sector, and with an awesome dividend that yields about 3.5%, with also a low payout ratio and a double-digit growth history. And yet, that's not even the best part. For me, what I'm most excited about is their future growth prospects, the biggest of which being their recent acquisition of Splunk, which was their largest in history. And look, guys, I actually liked Splunk even before the acquisition. I had it on a few of my stocks to buy videos, and now that it's together with Cisco, I feel like it's even better. This is kind of like the perfect match for them. See, Splunk is an AI and cybersecurity software specialist. They also do a lot of stuff with cloud, which helps Cisco diversify away from relying so much on hardware to now being what the CEO calls one of the largest software companies in the world, which Cisco was already pushing heavier into, with also the third largest market share in cybersecurity. That's something that almost nobody ever talks about, by the way, but Cisco is a huge player in these areas, and we all know how profitable those software-like margins can become longer term, especially combined with AI and other high growth areas, which the CEO had this to say about the entire package too, that they will now both power and protect the AI revolution, as they provide the infrastructure to power it, the data to develop it, the security platform to protect it, and the observability platform to monitor and manage it all in real time. And look, most cybersecurity and newer AI startups tend to bleed money on the bottom line. In fact, even Splunk was heavily in the red before being acquired, but Cisco has been around for decades with a proven track record of reliable financials and doing billions of dollars of profit every year. And so with the stock actually down right now, trading cheaper than the sector, and with a super attractive dividend, and now all of this future potential too stacked on top of that, I just love the entire package here, and I want to start adding it to both my portfolio and the community one as well in the coming weeks. All right, now with all of that said though, we are now down to the third and final stock. This is the highest risk option of the bunch in my opinion. And this month, I'm going to go with one of my favorite fintechs in the market, and that is SoFi, ticker symbol SOFI, who, like Cisco, has also been having a rough year so far, despite what I feel have been actually very promising signs for their future. Yet the stock has actually fallen about 30% year to date and is still down 3/4 of its entire value from the very top. Now, the biggest reason for this has absolutely to do with the horrible macro economy. We've got sky high inflation, sky high interest rates, and the constant fear of a looming recession. These things have been plaguing consumers really, and the entire economy. Of course, keep in mind, the vast majority of the economy is consumer driven, and this is weighing very heavily on consumers who, by the way, also have record levels of debt. So if you go into a recession or the economy gets even worse, well, what do you think is going to happen to those consumers? You're talking about delayed payments on loans, even defaulting, bankruptcy occurring, and all of those things can, of course, hurt any finance company, really, but also SoFi, who is no exception to that, as a big part of their business is, of course, lending. However, I actually think that if the economy was in better shape, this stock would be soaring right now. And considering all of the challenges that they've been facing, along with the fact that they're still a relatively young fintech, well, I actually think that their performance has been very impressive. And they're also doing a good job of diversifying as much as they can to help lower the risk while also working towards profitability. And if interest rates start coming down or the economy recovers, I think this will be a high flyer once again, and here's a couple reasons why. Now, first of all, last quarter wasn't even that bad. In fact, I actually thought it was pretty good. Sure, they guided a little less than analysts wanted to see for the next quarter, but earnings still beat on both the top and bottom line while actually raising guidance for the full year too, which I think is much more important. We also saw their most important growth segments in financial services and the tech platform rise by 54%, which they are now guiding to make up as much as half of all their sales this year. That's huge, guys. So it's helping them diversify their business into more growth oriented, more stable, and even higher margin services for their long-term future, especially in tech, because we all know how really financial services are becoming more digitalized every day. And SoFi is really disrupting this market with their all-in-one platform that continues to grow every quarter, adding another more than 500,000 members just last quarter alone. It was like more than 600,000. And the ones from their Galileo acquisition are also seeing a re-acceleration too. That's really big. And all of this is helping them cross-sell multiple products to their entire user base under one roof, creating a snowball effect with almost 1 million more products added last quarter alone. But the biggest news of all is how even in the current environment, SoFi has managed to work their way into profitability, with the last 2 quarters in a row being GAAP net income profitable. That's really big, guys. And if it continues, I mean, with a price to sales ratio of only around 3, I think you start valuing them based on profits instead. When you do that, the stock, I think, actually looks very attractive here. In fact, analysts project EPS of almost 50 cents by 2026. Based on today's share price, well, that would equate to a PE ratio for that year of only around 14. I think that's pretty cheap for a high growth fintech like this that grew sales by 26% last quarter and is operating in a giant market that is going to get even bigger. It's projected to reach a whopping $1.5 trillion in terms of market size by 2030. Again, it remains risky of a stock here because of the macro headwinds that could potentially get even worse before they get better. But I just think that, without that, I probably wouldn't get as cheap of a price here on this stock. So I want the stock while it is still low right now, so that when the macro environment improves, I can benefit from that lower stock price that should ideally recover longer term. Anyway, that's just my opinion, guys. That's how I feel about these 3 stocks. I hope that you enjoyed the video. Let me know what you think about them. If you agree or disagree with anything I said, I love to hear all types of different opinions. And let me know what stocks you're all buying out there in the market. I'd love to hear about them, and I'd love to include them in future videos for you as well. Anyway, thanks again for stopping by, my friends, and for all your support. It means so much to me. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.